This is Bloomberg.
This is the countdown to the open. I'm Matt Miller in for Jonathan Farrow. Moments away from the start of trading on Wall Street, you can see I-80 Gold Corp about to ring the bell at the New York Stock Exchange. MSP recovery at the NASDAQ. Bloomberg had an amazing story about the amount of billions lost by MSP recovery in the first few minutes of trading on its debut. Right now, we're looking at gains, though, on the S&P futures, up about 1/3 of 1%, so expect to kick off in the green on the S&P. The NASDAQ futures down about 1/4%. It's pretty steady. It's not tech stocks leading the way today, which may be a bummer. Russell 2000 stocks are up in futures. In terms of the euro dollar here, 106.99, not a lot of movement there. The U.S. 10-year yield coming down again for the third day in a row. Monday we were up at 286. Now we're looking at 274. And NYMEX crude continues a climb higher at $112 and change for Texas Intermediate. We're looking at Brent, the global benchmark, at about 115 right now. Joining us with a look at the stocks moving at the open this morning is Abigail Doolittle. Abby?
Well, Matt, we do have a bit of a mixed open here, but let's start out on the positive, and that, of course, is Alibaba. Shares are popping sharply higher this after the online giant in China reported a much better quarter than expected. They beat sales by 1.7%, profits by 12%, and so interesting here is that they were helped out by lockdowns in China, basically consumers stuck at home using the company as an online mall. Southwest Airlines up 2.3%, similar to United Airlines. They raised the revenue outlook, and in this case by about 3 to 4% on strong demand as folks really want to get back out there and traveling, a experience desire out there. Apple, on the other hand, this is the big weight on the NASDAQ 100, back below its 100-week moving average, down 2.2%. This, of course, as Bloomberg has learned that they plan to keep iPhone production held basically the same, ordering 220 million iPhones for this year from their suppliers, so investors not loving that. And then NVIDIA well off of the lows relative to when they first announced yesterday. The quarter was okay, but the outlook not quite as strong. And interesting, Creedy, is the fact that while the lockdowns in China helped out Alibaba, in the case of NVIDIA, it's a big headwind as for why the growth is less than what some would have liked.
Yeah, we're certainly going to be watching that and really stick to that tech theme. Abigail, thank you as always. Broadcom, speaking of tech, agreeing to buy VMware for, get this, a $61 billion, marketing the biggest ever takeover for a chip maker on record. Bloomberg's Alex Webb joins us now from London with the details. Alex, can we really call them a chip maker, just given how diversified Broadcom is?
Well, that's very much the point of this deal, that Broadcom comes into it with about 70% of revenue coming from semiconductors. If this deal completes, it'll be 50% in software and 50% in semiconductors. And that's significant because semiconductors are exposed to a huge amount of cyclicality. That's not only a function of supply chain issues, where we've seen a huge number of problems over the past 18 months, 2 years, but also consumer demand. That if the iPhone, for instance, they lose a component in the iPhone, or the iPhone demand itself isn't that great, then that would hit Broadcom. And then operationally, there are also some advantages too, namely that VMware makes virtualization software, the ability to access computers remotely. That plays very nicely with Broadcom's burgeoning data center business. Now, the issue is there's a huge amount of money going here. Whether they can extract some real savings from it, there's about $8 billion in operating expenditure, and that's what's going to be in the sight of Hock Tan, the CEO, as he tries to extract some savings.
Ton of moving parts, but obviously a huge deal. Alex, thanks very much for covering that for us. Alex Webb on tech. Let's get to another tech deal that hasn't happened yet and has taken a number of unexpected turns that are almost annoying. Elon Musk revising his Twitter bid again, dropping a margin load tied to Tesla and increasing the size of the deal's equity component. Bloomberg's Ed Ludlow joining us now from San Francisco with more. Ed, is he really going to do this? Is he serious?
Well, I think that Twitter shares being up 4% is a market indication that we think he is going to do this. The rebalancing as well, that is a de-risk for everyone, right? The margin loan component was already cut from $12.5 billion to $6.25 billion. Now he's removed that element entirely. There's still $13 billion of more traditional forms of debt, but $33.5 billion in equity that Musk has to account for. But you see Tesla shares higher by 0.6%. The idea being that with the decline we've seen in that stock, there weren't going to be enough unpledged Tesla shares to act as collateral to secure that margin loan anyway. In the filing that dropped late on Wednesday after the shareholder meeting, it outlined that Musk is talking to some existing investors about rolling over their public shares into a private entity, including Jack Dorsey. You'll remember that he already has pledges for $7.1 billion of equity financing, including Larry Ellison, Sequoia, people like that. The question is, how much more outside equity is he going to raise as part of that $33.5 billion tranche? What you see on your screen is the spread, right? Where we're trading right now on Twitter stock relative to the $54.20 per share offer. When I was standing outside Twitter HQ on Wednesday, Matt, merger arbitrage specialists, investors had a lot of doubts that this deal would happen at all, or they would think that he'd come back in at a lower price point. With the filing, a little more confidence this Thursday morning.
Yeah, it seems to be fueling the shares as well, especially as we see perhaps if that deal does go through, do the share prices go back at least closer to that 54.20 level? Ed Ludlow, thank you as always. Let's talk about some more stock stories here. Macy's joining Nordstrom and offering a little bit of relief after last week's disappointing retail earnings results. The company lifting its earnings outlook on strong spending despite the inflation. The CEO writing, quote, "We saw a notable shift back to occasion-based apparel and in-store shopping, as well as continued strength in sales of luxury goods." Bloomberg's Kaylee Lines is back with us for more. Kaylee.
Yeah, Cree, I think that commentary from the statement is so telling because they said, yes, macroeconomic headwinds have increased, but at the end of the day, our consumers are still spending. That is what enabled them to raise the high end of their earnings forecast for the full year out to $4.95 a share. It previously was only $4.52. It really highlights the difference between the high-end consumer that is still spending in the face of inflation and the lower-end one that is starting to pull back on some of those discretionary purchases due to higher prices, as we saw with Walmart and Target. Of course, that same dynamic is reflected in Williams-Sonoma, which topped sales expectations. It, of course, is a high-end retailer of home products. It's up 11%. But what's interesting is even in the face of some of these inflationary pressures, the dollar stores proving resilient, both Dollar General and Dollar Tree lifting their forecast, those stocks up by double digits early on. But of course, while we're getting a nice boost for all of those names this morning, it has been a very different story for retail on the year thus far. Apparel and general merchandise stocks each down about 24% year-to-date. Department stores a little bit better, but still down about 18.5%. Clearly, there has been a lot of concern about how these companies are faring in this inflationary environment and what kind of pricing power they are able to exercise, passing on some of their higher input costs. Now, some of that pressure could be starting to ease as you've seen the prices of some commodities like metals coming down and freight rates coming in as well. And of course, we see that reflected in break-even rates, which is the market's gauge of expectations for inflation over the next number of years. We have seen those coming in dramatically in recent months as well, Matt.
All right, Kaylee, thanks very much for that. Kaylee Lines there with a look at inflation expectations. Let's bring in Jonathan Golub, Credit Suisse Chief Equity Strategist, to talk about what we should expect in terms of inflation, in terms of the Fed, and really in terms of capitulation first, Jonathan, because that's been kind of the conversation. Do you think we've seen it, or do we not need to see it?
You know, Matt, as I'm looking at this conversation about inflation expectations coming down and the TIPS break-evens, which is really pretty startling. There's a couple of things that are interesting. If you look, and I love this, on my Bloomberg terminal, if you type in ECFC, you can see what the economists' forecasts are for inflation expectations for this year or next year, what have you. And those numbers continue to ratchet higher. So you really have like this battle between the economists who say this inflation issue is a bigger deal and investors who are putting real money to work who are saying perhaps this inflation is falling off. And at the same time, you have oil prices are ratcheting higher, and they almost always move with the break-evens. So this question about, you know, at the starting point of the whole debate is what happens to inflation. It's really murky. Now, we believe that the economists are more likely to be right, that the inflation is going to be stickier and harder to kill, and it's going to force the Fed to do a little bit more. But it's a pretty murky, question.
Jonathan, I'm curious about what the stock market is actually trading on. We were talking for a while about yields, about the dollar, about oil even as this inflation hedge, and then it became kind of this operating margin story, now valuations. What is the metric that the stock market is using as its signal?
It really is, we've done a bunch of analysis on this. It really comes down to this valuation issue more than anything else. At the beginning of the year, it wasn't that the stock market itself was so expensive. It's that the high growth companies, high PE, the high, price to sales companies were really in the stratosphere. And our big call for this year was not that the market would have a good year or a bad year, but that these high flyers were going to have to correct. I didn't really, at that point, know whether it was that the winners were going to come down or the cheaper stocks were going to rise up. But boy, when interest rates spiked, it was the catalyst rather than the cause. And now we're finding, if I use a baseball analogy, we're probably in like the 8th inning of the kind of correction that we needed to see in these very, very expensive names. So we think that maybe not all of the carnage is over, but if it's not all over, the vast majority is.
Yeah, I mean, a lot of people are saying, look, the pendulum often swings too far, right? I think we're trading around 19 as a PE on the S&P 500, closer to 40 on the NASDAQ. But those are back to more historical valuations, right? The NASDAQ has a lot of companies that don't make any E, so the PE is relatively, so that ratio is relatively meaningless. Do you start, if you have cash to invest now, do you start to get in if you have a longer term outlook?
Yeah, I think you have to. I mean, if you take a look, first of all, Matt, we're not looking at the valuation of the market. We're actually looking at the valuations within the market. So what are the most expensive stocks trading at compared to everything else? And that was really what was crazy out of whack at the beginning of the year. And that is much more normal. So the market internals are feeling really pretty healthy. Also, year to date, the earnings picture is up by about 6.5%. What I mean by that is if you looked at what the forward earnings expectations were on January 1st and you look at them today, you're 6.5% higher on that earnings outlook. So it looks pretty healthy. So stocks are cheaper. Earnings outlook is pretty good. The earnings revisions, that's how much the analysts are adjusting their numbers. Those actually keep ratcheting higher because for all of the noise and everything else, the economic backdrop is still pretty supportive for profits.
All right, Jonathan, thanks very much for joining us. Jonathan Golub there from Credit Suisse. It's pretty interesting. People are watching for capitulation using a number of different measurements, as you pointed out. We're looking at the put-to-call ratio. If it gets above 135, 140, then that could be a sign. We're looking at the VIX, but it needs to be around 40 or 50, and right now we're only seeing 28. So it doesn't look like we're close to there on pretty much any measurement.
Yeah, and remember, we had weeks and weeks of it was just selling nonstop, red on the screen day and day after. And now Sorry?
7 weeks.
Yeah, exactly. Yeah. And you had this massive streak, and now it's kind of flip-flopping. So there are some signs, as we talked about with our guests, about it bottoming out. But I have to ask, there's also a pretty big case that the stock market selling continues, that this is just a brief bounce. And I'm curious as to how do you navigate that if it's just going in a one-way direction?
If that's the case. Now, I also suspect that a lot has been priced in already, including, for example, what we expect from the Fed, including also what we expect from inflation. So it'll be interesting, especially to see the PCE number that Mike McKee was talking about tomorrow. Coming up, COVID lockdowns continue to weigh on China's recovery.
There's no doubt that the fight against COVID in China has had an impact, very short term, on the Chinese economy. But China is very determined.
That conversation coming up next. This is Bloomberg.
There's no doubt that the fight against COVID in China has had an impact very short term on the Chinese economy, but China is very determined and seems very convinced that they will be able to meet their growth targets, and they're not right now accelerating their infrastructure investments, and when they accelerate infrastructure investments, it's good for iron ore demand.
After months of anticipation, Secretary Antony Blinken's long-awaited China address is just moments away. Delivering remarks at the top of the hour, he warns of Chinese dominance in released experts, reading, quote, China is the only country with both the intent to reshape the international order and increasingly the economic, diplomatic, military, and technological power to do it. Bloomberg's Anne-Marie Hordern joins us now from Washington. Anne-Marie, what do we expect?
Hey, Matt, well, we're not going to expect anything in terms of any bold new initiatives. Likely, a lot of this is going to be highlighting what the administration has been doing, even though for months they've been talking about what their policy towards China is. Another excerpt that we know that Secretary Blinken will deliver when he gives this speech is that he's expected to say that under President Xi, the ruling Chinese Communist Party has become more repressive at home and more aggressive abroad. We should note this speech just comes days after the BBC released thousands of images of detained Uyghurs, some of them also under the gaze of baton-wielding guards. So it likely will be a human rights component to this. But when it comes to the strategy the administration has been using and what they are going to really market in this speech is three ways to deal with China. One, invest at home, things like the CHIP Act that Congress is trying to get over the finish line, bolster their allies and align with like-minded individuals in the Indo-Pacific, and then finally be able to compete with China economically and militarily.
I have to ask about the tariffs of this all, because as we talk about China, what comes to mind is the Trump-era tariffs that are still in play. President Biden saying that perhaps they would consider removing it. What's the latest on that front?
So President Biden, while he was in Japan, has said that when he got back to Washington, he'll be sitting down with Secretary Yellen, and this will be under discussion. He said this a few times. So because inflation is so high, many economists have said this could potentially be one lever the administration could pull to bring down inflation. The Peterson Institute and others have said that. But there is a group of senators, bipartisan, from Mitt Romney to Elizabeth Warren, signing a letter yesterday saying do not revoke these tariffs. They think that, one, it'll be bad for jobs in America, but also what does this send as a statement to China? So this is politically difficult, but also economically a difficult place for the administration. This is something they're going to be considering, but top officials say this kind of review of these tariffs will take months.
Anne-Marie Hordern from Washington, D.C., we thank you as always. Well, speaking of those concerns that Anne-Marie was just talking about, it seeps into the company story as well. China's COVID lockdowns weighing on the largest U.S. chip maker, NVIDIA, tumbling after reporting a disappointing revenue outlook. Meanwhile, Alibaba reporting better than expected revenue. And actually looks like NVIDIA came back up, but it was certainly down in the pre-market. Bloomberg's Kaylee Lyons is back with us. Kaylee, break it down for us.
Well, Creedy, this really highlights the uneven impact of COVID zero policy. On the one hand, NVIDIA, as you say, came up short in terms of its revenue guidance. The issue is not demand. The issue is its ability to meet that demand, given some of the supply side challenges stemming partially from the war in Ukraine and sanctions on Russia, but in large part also because of COVID-related lockdowns in China. That hampers their ability to produce the chips that they need to. For Alibaba, though, the e-commerce giant in China, it's a very different story. Actually, everyone staying at home is a boon for this company. Revenue was up 9%. That was higher growth than expected as consumers turned online for basic needs as lockdowns spread across the country. And it also is a signal that the consumer is still spending, which maybe lends a little bit of optimism to the growth story in China more broadly. Though, of course, due to that uncertainty around COVID and its trajectory, the company did not give a full year revenue outlook. And obviously, Alibaba is down about 57% over the last year, because that's not just about COVID zero. It is also about the regulatory overhang for these Chinese tech companies. And that is not limited, of course, to Alibaba. The NASDAQ Golden Dragon China Index is down about 29% year to date, JD.com by about a quarter, and then DD Global off by 63%, though part of that story is a delisting one. There's still a lot of debate around delistings of these Chinese companies listed here in the U.S., auditing rules. Those two countries still debating that. That's kind of a whole other ball of wax, Matt.
Yeah, definitely a double whammy there. So much hanging over a number of Chinese stocks. Kaylee, thanks very much for that. Coming up, the market-moving events that you need to be watching. We're going to give them to you next in our trading diary. In terms of the markets right now, you can take a look at what's going on across the boards. Equities are up 1% on the S&P 500. All right, it is now time for our trading diary. We're going to get to those things that you need to watch in just a moment. First off, S&P 500 up 1.25%, NASDAQ gaining 1.33%. So this is the NASDAQ 100, but actually tech stocks look to be doing okay today, right? The Russell 2000 is still a leader. As Critty was saying earlier, that's going to be front and center, but tech stocks aren't doing poorly, right?
They're not doing poorly. It's a momentum trade to me. If you have tech up, you have Russell up, it's momentum.
All right, that's what she's here for. Time now for your trading diary, what you need to be watching this week, and there's only a couple days left. That's Secretary of State Antony Blinken speaking on policy towards China in just about 5 minutes' time, or at least that's when he's scheduled to. Fed speak coming out from Vice Chair Lyle Brainerd at 12 p.m., so get ready for that at noon. Then the Treasury is going to sell $42 billion of 7-year notes at 1 p.m. That'll probably happen without you even noticing it. We're going to get personal income and spending data tomorrow. Tomorrow, there's going to be a ton of cool data. We're going to have housing data as well. Rounding out the week, the University of Michigan Consumer Sentiment Survey. This pains me, Critty, as you know, because...
Why? Do you have low consumer sentiment?
I hate the University of Michigan.
Oh.
I'm a Buckeye. But I guess it doesn't mean very much to you or anyone else, frankly.
No, I get it.
It's very important to see how the consumer feels right now because we're so worried about a slowdown, stagflation, a recession, and that has so much to do with it in this economy, right?
And speaking of the housing data you just mentioned, I mean, I feel like I was surprised that you didn't even mention that you just bought a house. This is important.
At the very top of the market.
Very top
at
of the
the
market.
very top. And
it's
now
a clear point of pride with you.
Exactly.
But I think it's important when it comes to the slowdown. We're talking about a housing slowdown here, but if you actually look at the housing market, that supply-demand imbalance is still pretty extreme.
Right, and that was actually Cameron Kreis. I keep going back to the column that he wrote yesterday because I think it was so brilliant. The point that he made is in 2007, 2008, when demand dropped, supply was still ramping up like crazy, and we don't have that now. There's really no supply out there.
Yeah, and I think it's also hard to talk about it regionally because what you're seeing in New York City might not be what you're seeing in, say, Oklahoma, for example. So the national housing story is a fascinating one.
Oklahoma. All right, this was the countdown to the Open. We're in for John Farrow. We miss him. This is Bloomberg.